Welcome again to Kings and Queens accounting class. Today we are going to be looking at adjustments to final accounts. So now that we have completed the drafting of the income statement or the trading profit and loss account and the balance sheet, we're now going to be moving to look at the adjustments to the final accounts. There are some adjustments that need to take place from time to time in the companies or the business final accounts when we are going to be drafting them. One of such is depreciation. Depreciation takes place as a result of the usage of the asset, and by that I mean fixed assets. Fixed assets such as machines, building, furniture, tools, equipment, yes, all of those, because they are bought, the fixed assets are bought and placed into the business, and they are used on a daily basis to support the operation of the business. What happens is, by their frequent use, they are losing their value. Yes, they are losing their value. And businesses and directors and owners really want to be able to know when is the right time to do the replacement of assets. Yes, at what point should I replace my asset? At what point would I have used enough of that asset so I can replace it with something newer, something new? All right, another asset that is new. So depreciation comes in to be very important. The first thing we want to do is, as per usual, we have some objectives here. What is depreciation? What are the causes of depreciation and the methods of depreciation? Now we're going to begin with the first one, what is depreciation? All right. Now depreciation is that part of the fixed asset that is consumed over its period of use. That is, while you are using it, yes, it is deteriorating. And because it is deteriorating, it is losing its value. Okay? And that is what is referred to as depreciation. That part of the fixed asset that is consumed over its use. All right? So, just for clarity, so it is that part of the fixed asset that is consumed over its period of use. Making sure everybody gets it. All right? Now that's what we refer to as, oh, there's a D missing here, fixed asset. All right. Now, what are those causes? Several textbooks will give you varying causes, but I'm going to be identifying a few of them at this time. One has to do with wear and tear. Right? Wear. So one causes wear and tear. Now, wear and tear means as a result of the fact that you're using it, yes, it is going to be worked in a way that it becomes worn, right? You own a car and you're driving it for a number of years. It has to deal with the severe terrain of the road, the weather condition, rain, sunlight. So it affects the physical component of the vehicle. So the value will deteriorate. All right. So physical deterioration takes place through wear and tear. Of course, also as a result of erosion. Yes. So we may have a situation where the asset is because by virtue of erosion. All right. So or rusting. So when it is exposed to the elements, when the asset is exposed to the elements, then it will rust or it will rot. All right. So these are causes that will impact on the asset to cause it to lose its original value. All right. There is the other element that affects the, referred to as in some texts, economic factor, one of which is referred to as the asset being outdated. I'm using simple term, outdated. Others will refer to it as obsolete, right? Obsolete. It is outdated. Obsolete really means the same thing, outdated. What does that mean though? An asset become obsolete or outdated. Really what they're saying is that it has far past its time. For example, there used to be what we in offices, typewriters, that you press with your hands to type. Those would not be relevant today in this age because those are outdated, right? The computer would have been the modern equipment to use in the office instead of a typewriter. Yes, so the typewriters would have been considered to be obsolete or outdated. It no longer has the relevance to produce efficient work in the offices. All right, so outdated. It may be outdated or obsolete. Number 4 is the asset may have a certain legal life, right? The legal life is ended. And what do I mean by legal life? What we're talking about is that, for example, when you take out a lease of a property, when you lease a property, you lease it, for example, for 10 years. And therefore, as a time factor, the valuation of your time will soon be ended. So you are calculating based on the depletion of your time or the reduction in the time that you'll have on the property. So lease arrangements with a limited legal time for access of the asset, for example, the land or the building. Patent, yes, patent also is similar, right? The patent, you have certain rights, for example, mining, and you have certain number of years and rights to mine a certain mineral, right? And as a result of that, the time where your rights, the time period of your rights will be limited. So if it is 30 years and you're coming to the end of the 30 years, so you know your whole operation or usage will be depreciated. All right. So we're saying depreciation occurs wear and tear, erosion or rust, outdated. We also refer to as being obsolete. There is another reason that I'm going to be sharing here. 5. The asset becomes inadequate. The asset becomes inadequate. So you talk about inadequacy. Asset become inadequate. Now, what do we mean by inadequate? The business has expanded. So let us say you start a small business, and for example, a bakery and a small oven was good enough to produce the amount of goods that you need, amount of bread or cake that you need to produce for that particular day. But the business has now expanded, and so there's a demand for greater production. So a small oven would not be adequate, yes, in dealing with the demand of the business. So you would have to do a replacement. So 5 reasons granted here: wear and tear, erosions or rust, outdated, or what we also call obsolete, legal time is ended, so that patent and lease of property, inadequacy or inadequate, it means that the asset is not productive anymore based on the demand that exists in the business. So those are some causes for depreciation. I'd like to move on quickly to indicate to you that depreciation, when we talk about depreciation, it's referred to as a non-cash expense. Depreciation is a non-cash expense. You're not literally spending money. It is a depreciation, is an expense, but a non-cash expenditure. What you're doing is really writing off the amount of loss or reduction in the value of your asset against your income. Yes? So that in the event that it is time for replacement, you would be able to do so. That's why you have what is called provision for depreciation. You put an arrangement in place to see at what point in time you will be required to replace the asset. But we're saying that depreciation, it is an expense, but it's a non-cash expense. And again, what we mean is that depreciation, money is not moving out of the business. It's not changing hands, right? It's just a bookkeeping operation that is taking place when it comes to depreciation. As against rent and wages and salary, monies are changing hands. It is leaving you to pay your workers, or to pay your landlord, or to pay somebody else, right? Those are different cash expenses, but depreciation is a non-cash expense. There are two, moving on quickly, there are two main types of depreciation that we're going to, method of depreciation that we're going to be seeking to discuss. Not that they are the only ones, but they are the popular and the common ones that are used in most businesses across the world. All right? And they are the straight line method, 1. Straight line method, and 2, the reducing balance method. Okay. Now there are others, as I say, the sum of the digit method, the horsepower method, right? Those are other varying methods. But at this level of your training, it is critical that you know well these two methods. And as I said before, they are popularly used and frequently used across the world in businesses. All right? Straight line method and the reducing balance method. Now, the straight line method has, well, while both of them originally were created with a formula, right? The reducing balance formula is very difficult for the layman to work out. Alright, so, but the straight line method, yes, has a simple formula. To do the straight line method, it is the cost of the asset, minus the disposal value. Divide by the number of years. Now, sometimes it is referred to as a disposal value. Other times it is called the estimated value, or the residual value, or the scrap value. These are concepts or words that are used to relate to the value that is left within the asset. Disposal value, scrap value, estimated value, residual value are what are used to describe. Now, this is a simple formula for the straight line method. So for argument's sake, if the asset cost $4,000, yes, and you use it for 2 years, and when you are selling it, the sale price for it was say $2,000. All right, now we can plug in the values to find what the cost of the depreciation for each of the year. So if we do that, the formula, rewriting the formula, cost minus residual value or disposal value divided by the number of years. So it would be, cost would be 4,000 minus 2,000 divided by 2. So this will be 2,000 divided by 2, and 2 into that now is going to give us 1,000. So the depreciation would be equal to $1,000 per year. Okay, so that's really a simple version of the straight line method. All right. With that said, we can move on now to look at this question. It says a car costs $6,400 after 4 years. It was sold for $200. Calculate the depreciation for each. All right. And they say the reducing balance method rate is 50%. All right. So let's commence that activity. So we're doing the straight line method. So for this question, the cost, again, I always like to write it enough times so that you'll remember. Disposal value over the number of years. Okay. Now, so the cost is 6,400 minus 200, which is the disposal value, 200, not 2,000, over how many years? 4 years. So when we take that from that, we are going to get 6,200, and we're dividing that by 4. All right, let's do the mathematics now. 4 into this going to give me 1, and they're going to give me 2 here. 4 into 5, right? So we're going to have 20, 2, 5. All right. So we're looking at what now? 4 into near $1,500, maybe 4. But let's double check that. So if we continue it, so if we 4 into, yes, so this would be 0. Yeah, so dividing 4 into 6,200, we should be getting $1,550, right? Correct. So what this is saying then, each year we will be charging $1,550 for depreciation of the asset. All right. Let's look at, and we can now show, because sometimes you're asked to, show it, for exam purposes, show it in the form of a table, how the spread of depreciation affect the asset over the number of years. And a table could be presented in this form. The cost minus depre is equal to book value. The question that you may ask is, what is book value? Well, book value represents the current value of the asset at the end of each year. Book value represents the current value, calculated value of the asset at the end of each year. So, to to show the operation for the 4 years, how would it look for the 4 years? We could, for year 1, it would be 6400, yes, minus depreciation, which is 1550. So when we subtract that from, when we make the subtraction, what would be our book value? All right, so when we subtract the 1,550 from the 6,400, we should be getting something look like 4,850. All right, so the book value at the end of the first year will be 4,850. Year 2, 6,400, right, minus 1,005 plus 1,005, 550, sorry, 1,550. And the question is, why am I doing it this way? Well, first of all, the cost of the asset does not change. According to the accounting concepts and convention, assets are normally recorded at cost. So once you purchase the asset for a certain figure, that is what it's going to cost for the rest of its existence, right? Cost you for that existence. For example, if you buy a bag for $300 10 years ago, somebody asks you today, how much did you pay for it? How much is it for the bag? You're going to tell them, I paid $3,000 for it or $300 for it, right? So the cost does not change. Whatever you had purchased it for, that is what remains the cost. But the straight line method, this is, we now are going to introduce some concept here. This is the what we refer to as the accumulative depreciation, ACD, accumulative depreciation, and PD, present depreciation. This is depreciation. This is this figure. So we add these two, subtract it from that. All right. So this is going to be, in our maths, going to be, let us say now, 6400 minus 310. That's 003, and this is going to be 3. Not so? Yes. Good. So the book value at the end would have been 3,300 for year 2. Right? Shall we go to year 3? 6,400, and this would be the accumulated depreciation. Now would be 3,100 plus 1,550. All right. So what we're going to be doing now is that this would be 4. So it will be 4. Yes. 4, 6, 5, 0. Right? Subtract it. 0. This is going to be 5. Yes. And we're going to have 3 here. Take 1 from that with 13. And that is going to be what now? 6, 7. And this is going to be another 5, 1. Good. Good. So, the book value would be 1750. All right. Year 4. Year 4, it is still the 6400 minus, and the total of this was what again? 4650 plus 150. So if we add 1550, we're going to get 0 here. This is going to be 1112. Yes. And this is going to 5 6, yeah? Yeah? Yeah. So, subtract this from the 4 will be 200. Alright? So, basically, it may take a little while and quite a bit of calculation, but showing the spread of how the asset is depreciated over the 4 years and in a table format, right? And these are the book values, okay? And again, we say the accumulated depreciation. These are referred to as the accumulated depreciation, and these are the current depreciation. Now, the idea of a straight line method of depreciation is really suggesting that it is the same amount that you have calculated that will be charging to the asset over the period of its life. So you will notice that on all of the years, the figure remained the same, 1,550. And if you plot that into a graph, then it will come out year 1, year 2, year 3, year 4. And that is why I refer to it as a straight line method, because if you plot the depreciation over each of the years, it will end up with a straight line. Hence is what is referred to as the straight line method. Alright? So this is the straight line method calculation. Alright, we have one other aspect to this lesson, and that is the reducing balance method. Now let's go. The cost of the asset cost is 6400, right? And they have indicated that each year we should charge 50% as the depreciation. So for year 1, the depreciation times 50%. 50% of that will equal to 3,200, right? So for the first year, the depreciation charge on the asset is 3,200. For year 2, the idea of the reducing balance method, after the first year, you are simply going to be using the book value times the percentage. Alright? So let me just write this right here so that you get it. Right? After first year, so after first year, use book value times the percentage. Right? So after the first year, use book value times the percentage. So what would be the book value? This is the depreciation. We subtract the depreciation from the cost. So cost minus depreciation give us book value. So what we'll have is the 64,000 minus, 6,400 minus the 3,200, and of course you're going to get the 3,200, which is the book value. All right. Now we'll find the percentage of this for the second year, which would be, so the second year, the cost is going to be, the depreciation is going to be this times 50%. And half of that now is going to give us, what is it now, 1,600? It'll be 1,600, right? All right, so the depreciation for the second year would be 1,600. All right. For the third year, we again going to use the book value, so it's going to be the 16 times 50%, yes, and that now is going to give us 50%, 800, right? 800 would be the depreciation for year 3, right? And we could move on to year 4 over here. Year 4, Therefore, it's going to be 800 times 50%, and that is going to be 400. So, in the first year, using the reducing balance method, that's the first depreciation. Year 2, the depreciation is 1600, and year 3, depreciation is 800, and year 4, the depreciation is 400. Okay, we're using the reducing balance method. What I want you always to remember is this information right here. This information right here that I'm encircling now. When you're doing the reducing balance method, after the first year, use the book value times the percentage. So you always, and how do we find book value? It is the cost minus the depreciation that gives us the book value. All right. Thank you very much for sharing with us today. We seek to share with you the processes of dealing with depreciation, how depreciation is charged or calculated, and we also looked at the causes of depreciation. And one last thing I want to share with you, in the profit and loss account, if I may just jump into that before I close. So, depreciation in the income statement. Right, in the income statement will find itself underneath, under the expense area of the expenses, right? Of, let us say, depreciation of van, right? So it is a part of the expenses. It is calculated a part of the expenses such as rent, wages, stationery. Alright, so depreciation is included in the expenses. When it comes to your balance sheet, yes, the depreciation now is done, written off against the fixed asset. So for example, for a fixed asset, and let's say the fixed asset is the car. So car at cost, and let us say car at cost was the 6,400. For the first year depreciation, using the reducing balance method, we less depreciation.